Peter Lynch is the man in the myth and the legend. He ran the Magellan Fund at Fidelity between 1977 and 1990, where he achieved a 29.2% annual return. This guy is the investing master. He also wrote the book One Upon Wall Street, which you know at this point is required for all value investors. And on top of that, it's one of the best-selling stock market books of all time. Now, Lynch does not do many interviews, but we can watch a lot of his commentary recently, looking for insights that specifically apply to the market condition that we see today heading to 2023. I was surprised by how much stuff I found that was helpful for right now. So as we know, our main issue running into 2023 is high inflation and a rising interest rate, which are causing asset prices like stocks and real estate to suffer. It looks like they are going to be a big issue throughout 2023 as well. So with that in mind, let's first hear Peter Lynch's opinion about investing during times when inflation is up and the interest rate is rising, and what he says might just surprise you in how perfectly relevant it is in the environment.
People understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's, has done very well as a company,
right,
the stock has done very well. People worry about too much money supply, what's happened to the price of oil, who's the president, who's being nominated for the Supreme Court,
it's all
the ozone
earnings.
layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
Yeah, but what they will say to you, Peter, is that, as you know, and why am I telling you this, but anyway, it's fun to tell you this, they're telling you that these other things influence the amount of earnings of a particular company.
Yep.
If we're in a recession, people are not going to spend as much money on going to the movies
Absolutely.
or whatever they do.
Right.
And therefore, you got to pay attention to these other things because they impact on earnings.
They are very important, but you have no idea of knowing what they're going to do. Alan Greenspan's the head of the Federal Reserve.
Right.
He cannot predict interest rates.
Yes.
He'd be the first to tell
He can
you.
influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years. He's even surprised how low they are now.
Right.
So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of 82.
Yes.
1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. Yeah. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about these things.
Don't focus on macro. You know, his point is that yes, the macro is important and yes, it influences the price. But as an investor, it is one of those things that is short-term and you can't control it. So if you can't predict it and you can't control it, then why should you spend your time thinking about it? This is the trap that many investors have fallen into this year. And honestly, it is fair because it is all that the media has been talking about. You know that the Fed has had another meeting and they have raised rates, and the Bureau of Labor Statistics was released this month, but you can't get caught up in that sort of stuff as an investor. You need to be laser focused on each potential investment you're looking to make and judge each opportunity on its own. Stocks are not lottery tickets. There is a company behind every stock. If a company does well, the stock does well.
Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. If anybody would predict interest rates right 3 times in a row, there'd be a billionaire. Considering there's not that many billionaires on the planet, there can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. But I'm trying to tell you it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rates are going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that.
Well, that is the classic line by Peter Lynch. But it hammers home the idea that macroeconomics kind of makes the world go around. It is not what we as long-term value investors should be focused on. For example, 2007 was the last time interest rates were higher than they are now. But imagine not buying a business like Amazon, Apple, or Google just because you were scared of interest rates. It is a bad call in hindsight, but even today with the market down, there will still be tons of investors bailing on their portfolios based on the fear that interest rates could go a lot higher and stocks may suffer. As Peter Lynch says, what we need to be focused on is the earnings of each company. When the market falls, however, things begin to shift in the long-term value investor's favor. And that's really what you need to remember when the market falls. We need to focus on the long term. I may have been right 6 times out of 10, but if I am right, I make a double or triple occasionally.
I might have been right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be. Corporate profits have grown about 7 or 8% a year. That means they double, including dividends, about every 10 years, quadruple every 20, go up 8-fold every 40. That's the kind of numbers you're interested in. Betting a 10-year bond today is a little over 2%. So I think the stock market's the best place to be for the next 10, 20, 30 years. The next 2 years, no idea. I've never known what the next 2 years are going to bring.
That's a very good point. And you know, the interesting fact that nobody knows. I could get that point across to more people, you know, that in the next 2 years it could go up or it could go down, and there is no way to know which direction. But over 10 or 20 years, the likely outcome becomes much clearer. Over 10, 20, and the likely outcome becomes much more clear. We can take a coin and flip it. I have no idea what the next 1,000 points are going to do.
We could take a coin out and flip it. I have no idea what the next 1,000 points are going to do. The next 6,000 points are going to be up. The next 14,000 points are going to be up. The next 20,000 points are going to be up.
But you don't know what the next 1,000 is going to be. It
Nobody
could be down,
does.
could be up.
Nobody does. And it's futile to try and guess it. Corporate profits will be a lot higher 10 years from now. They'll be a lot higher 20 years from now. That's what you could rely on. Microsoft didn't exist 20 years ago. Staples didn't exist 20 years ago. Federal Express didn't exist 20 years ago. New companies will come along. That's what makes
Cisco
stocks
didn't
go up.
exist 20 years ago.
That's what makes Amgen has 2 $1 billion drugs. They didn't exist 20 years ago. New companies will come along. That's what makes this country work.
So that's the game. Stay focused on the long term. You must focus on the companies that pop up on you, that you understand the ones that have a competitive advantage, the ones that have really well-oiled management teams, and lastly, and importantly, the omnis that offer a steep discount to strict eye value. And this has been the problem over the past few years. Unfortunately, there have been many wonderful business out there. Not basically all of them have been all high prices, and so much they have really did need to execute over the next 10 years for their valuation to be justified. This the Peter Lynch exactly talking about. You say to yourself, I think this company is going to earn something in the future.
You say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say it has to work, and then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. You say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't know.
So that's really going to be the secret to investing into 23. If I'm right, I'm going to double, trip the money. If I am wrong, maybe I will lose 30 to 40. That's a favor ratio if you say I am right. The stocks, and it's time wrap. So what's your opinion on the stock market?